Let's go ahead and go through our inventory costing example. You should have a handout available for you to see the example in front of you as I go through it, and also jot down the answers, hopefully ahead of me, so that you can see if you're understanding the concepts. So we're going to go back and use another one of those very highly simplified examples. This one, once again, will use umbrellas. Our assumption will be that there's a person named Noah, and Noah sells umbrellas on the street corners. It's July. It's been very, very dry, but Noah keeps thinking that there's got to be lots of rain on the way. So he starts purchasing umbrellas, waiting for the rain. And as you'll see later, he also hires some friends, and they buy the same things that he buys, and they're ready to sell umbrellas too. Then they just sit and they wait for the rain. What you're looking at on the bottom of the page here in this chart is a chronological history of Noah's purchase activity. So he started the month of July out with 60 black umbrellas. The BI here stands for beginning inventory. So Noah had 60 black umbrellas that he purchased sometime previously, and they all happened to be black. Back when Noah purchased those umbrellas, he paid $5 a piece for them. So if you take the 60 umbrellas times the cost each, cost per unit, you can see over here we have 60 umbrellas with a total cost of $300. Then we have his purchases during the month of July. So he wasn't selling any umbrellas during July because it just refused to rain, but Noah believed it was going to rain, so he just kept stocking up. So on July 3rd, he purchased 100 blue umbrellas, and there was a little bit of inflation. It's the same umbrella, just a different color. This time he paid $5.50 for those umbrellas. Then on July 10th, he went out and bought 150 green umbrellas for $6 each. On July 17th, he bought 100 red umbrellas. And there was lots of inflation this month, apparently. They now cost $7 each. And then finally, in late July, it rained, and Noah was able to sell some umbrellas. And in fact, as you see up here, he sold 330 umbrellas in those last days of July for $10 each. Now you don't see the $10 anywhere in my schedule here because this schedule is reconciling the cost of goods that Noah had available for sale during the month of July. So this is actually set up sort of like our cost of goods sold schedule or our cost of goods sold model. Here's the beginning inventory for Noah in units and dollars. And then these were all of the purchases during the month of July. So if you take the beginning inventory and add up all of the purchases, you have goods available for sale. And that's what this GAS stands for. Here we have the number of units available for sale, and over here we have the cost of goods available for sale during the month of July. Now the other thing that we know here is that if Noah had 410 umbrellas available for sale, then all of those umbrellas either got sold or he still has them in ending inventory. And the same, of course, can be said for the dollar amount. The total cost available for sale for all of the umbrellas, beginning inventory plus purchases, that cost needs to be assigned to the umbrellas Noah has left at the end of July and to cost of goods sold. Assign it to the cost of those umbrellas that got sold during the month of July. So you'll see soon that what we'll be doing is assigning this 2,450 to ending inventory or cost of goods sold under each one of those four costing methods that we discussed previously. Well, let's start just by doing a physical reconciliation here of units. So if Noah had 410 umbrellas available for sale and he sold 330, how many units, how many umbrellas were left in ending inventory? Well, of course, it would have to be 80 because 330 plus 80 would equal 410. In a similar fashion, we'll now go in and assign this 2450 cost to ending inventory and cost of goods sold. First, though, I want you to recognize that this schedule that I've shown you here, this inventory reconciliation schedule, would really be the first step that you would do in any kind of inventory costing problem. You would organize your inventory chronology in this fashion. You'd start with your beginning inventory. You would add in chronological order each of your layers of inventory, each separate purchase made at a different price, so that you knew exactly how many items were available for sale. And if you would then have to know either how many items were left in ending inventory or how many items were sold, and you could back into the other one. Having the information organized in this fashion, both with units and dollars, is what is going to allow us to compute these two numbers under each of our four methods. The first method that we're going to use is the specific identification method. And I refer to these methods as all really just applying an assumption, but the specific identification method isn't actually an assumption, because remember that companies who use this method actually have the ability to identify how much they paid for each particular unit of an item that's in their inventory. Because doing that can be difficult, even with barcodes and that kind of thing. You can picture like CVS, right? So they might have, 20 different 3-ounce tubes of Crest toothpaste sitting on the shelf. And the problem is, yes, the barcode will identify that those are 3-ounce tubes of Crest toothpaste, but some of them might have been purchased in earlier months, and CVS may have paid something different for some of those tubes of toothpaste. So there can be a lot of data that's necessary to associate a specific cost to a specific item in inventory. And because of that, the method is most often used when a business has really high cost items, and generally they have a relatively low sales volume of those items. So high-end jewelry, those kinds of things, antiques, certainly cars with their VIN numbers would be very easy to track using the specific identification method. It also makes sense when it's really important for a company to exactly identify items in inventory. So basically this method would be fairly intuitive. The business has to have accounting records that show the cost of each inventory item. And so every time they sell an item, they go look up the cost, and they take that cost and remove it out of the inventory account and put it into cost of goods sold. Well, let's see if we can apply that method to our umbrella example. And we can, because I just set it up to be simple in this way. Each time the cost of the umbrellas changed for Noah, the umbrellas were a different color. So Noah can identify the cost of every umbrella that he sold and that he has in inventory just by looking at what color they are. So what we're going to assume is that at the end of July, he's standing on the corner looking down, and at the end of July, what he has left is 10 black umbrellas, 20 blue, 10 green, and 40 red ones. As long as we know either which umbrellas were sold or which umbrellas are left, we can back into the other item. So the 10, 20, 10, and 40 up here, these are ending inventory numbers. Let's compute the cost of that ending inventory first, and then we'll move forward and compute cost of goods sold. Well, I've set up some little schedules for you that look like this, and they sure don't have to be this fancy. Usually if I'm doing this, I just jot down on a piece of paper ending inventory and cost of goods sold. And then when I'm doing costing problems like this, I ask myself, how many units am I trying to account for in each one of these categories? Well, in this case, we know that there's 80 umbrellas in ending inventory. That's just adding up all the numbers that were on the previous slide. And if there's 80 umbrellas in the ending inventory pile, we know there's 330 umbrellas that must have been sold. So here we want to come up with the cost of these 80 umbrellas using the specific identification method, and then over here the cost of the 330 umbrellas using that same method. Well, you just go back and you look at your original schedule. Noah knows he has, at the end of July, 10 black umbrellas. If you go back and look at the original schedule, you'll see that the black umbrellas that were the beginning inventory cost $5 each. So that layer of inventory is 10 times 5 or $50. What's the next layer of inventory? Well, looking back, Noah has 20 blue umbrellas. If we go back to this original schedule, we can see that the 20 blue umbrellas cost Noah $5.50. So we can put that in our schedule. So here's the 20 blue umbrellas at $5.50 each. And then I just do the same thing for the other umbrellas. This was 10, I believe, green umbrellas and 40 red umbrellas. Multiplying across and adding them all up for these 80 umbrellas, 10 plus 20 plus 10 plus 40, the cost of these 80 umbrellas is $500. The next step is to compute the cost of the umbrellas that were sold under the specific ID method. And we know this has to add up to 330 umbrellas. And once again, go layer by layer. So we know that Noah started out, if you go back to the original schedule, Noah had 60 black umbrellas at the beginning of July. At the end of July, he only has 10 black umbrellas. He must have sold the other 50. So 50 times 5 is $250. And you just follow that same logic with each of these other numbers. Go back and see how many blue umbrellas Noah had originally. That minus the 20 is how many umbrellas that we are assuming got sold. Take a minute, pause this, try it on your own, and then come back and compare to my answers. A good double check for you is that, remember, the cost of ending inventory and the cost of goods sold have to add up to $2,450. Every umbrella either ended up in ending inventory or cost of goods sold. So these two things will always add up to the total cost of goods available for sale. All right, well, here's where you should have ended up. There were 100 blue umbrellas originally. There's still 20. Noah sold the other 80. And follow the rest of that logic down. Total umbrellas sold is 330 at a total cost of $1,950. And, as hoped, 500 plus 1950 is 2,450. Total cost of goods available for sale. Now, an easy way to get the 1950 would have just been to take the 2,450 minus the 500. But doing it this way, we have a good sense that we haven't messed something up in our computations. It's a good double check to do both of these. All right, well, let's move on to the average cost, or I like to call it weighted average cost method. Weighted average just reminds you that indeed we're doing some sort of weighting where we weight the cost of those items that you have more of more heavily than those items that you have less of. The schedule that we built previously has all the information that we need to do a fairly simple amount of math and apply the average cost method. These are the steps that you need to apply the average cost method. You start by computing the weighted average cost of one unit. You multiply that by the number of units in ending inventory if you're trying to compute the cost of ending inventory, or you multiply it by the number of units that were sold if you're trying to compute cost of goods sold. And as I said before, to do this computation, you just need to look at the schedule that we set up already. Let's do that now. To get a weighted average cost of one umbrella, you'll simply take the total cost of goods available for sale, which is this line item here from my schedule, and divide it by the total number of units available for sale. So in this case, we come up with $5.98 an umbrella. You don't want to round this number too much, or you will lose accuracy. If you round at all, And I did here, you're introducing a little bit of rounding error into your computations. So at the end, you just want to make sure that you round such that total cost of ending inventory and cost of goods sold add up to $2,450. So this number sounds about right. It's not the simple average. You'd get a different answer if you just simply averaged 5, 550, 6, and 7. It's weighted more heavily towards this end of the scale, which makes sense because we have way more of the more expensive umbrellas than we did of the cheaper umbrellas. And you don't really need the grids for the average cost method, because remember, step 2 is just simply taking that average cost that we just computed and multiplying it by the right number of units. So to get the cost of ending inventory, it's 80 umbrellas times $5.98 each, and to get the cost of goods sold, it's 330 umbrellas times $5.98 each. Now again, since I have some rounding error introduced here because I rounded to the nearest penny, I need to round these amounts as well. I want these amounts to add up to $2,450. Well, let's move on now to the first in, first out method, or the FIFO method. FIFO is the most common method that's used in the United States. The FIFO flow, as the name will tell you here, the first stuff in is the first stuff out. That's describing the fact that our assumption is you're always selling the oldest possible goods first. What that means is that your ending inventory will consist of the newest possible goods or the most recent purchases. Let's apply those facts to our umbrella example. So here are those same little blank schedules that we'll be filling in. I like to have a little talk with myself when I'm doing these things. So in this case, we're going to start by computing the cost of ending inventory under FIFO. I always ask myself, how many units? Well, we know that's 80. And then this question, should they be the oldest or the newest units? This is FIFO ending inventory. Under FIFO, we assume that you sold the oldest stuff, that the letters are describing what got sold, not what is left. So the assumption is that you sold the oldest items, so we're going to assume that your ending inventory all consists of the newest possible items. So I would actually write the words newest here at the top of the schedule so that I keep it straight. So for FIFO, we're looking for the newest 80 units, and those costs are what we'll be taking here. So with FIFO, you're starting at the bottom of that cost reconciliation schedule. Let's go back and look at that schedule again. So we want the newest possible umbrellas. So remember that we have Noah's got some black, blue, green, and red umbrellas all sitting there at the end of July. We are going to cost them for accounting purposes, however, as if they're all red ones. Noah had 100 red umbrellas available for sale. The 80 that are left are all going to be assumed to be $7 umbrellas. So $7 is how we'll cost those 80 umbrellas. If there wasn't 80 umbrellas, at least 80 umbrellas in this layer, we'd go to the next newest, then the next newest, then the next newest. So ending inventory is 80 umbrellas costed at $7 each, or $560. Now see if you can compute cost of goods sold. With the FIFO method, the first stuff in is the first stuff out. That's describing what was sold. Remember, these are the newest items. These would be the oldest items. So go back to that inventory schedule. You're going to start at the top of the schedule and keep taking layers until it adds up to 330 units. So we're back here to this reconciliation schedule again, and we're looking for the 330 oldest possible items. So we're going to take all of the $5 umbrellas, all of the $5.50 umbrellas, that's 160, all of the $156 umbrellas. That adds up to $310, and I need $330, so we're going to include 20 of the red umbrellas at $7 each. So those are the numbers that will fill in on our schedule: 60, 100, 150, and 20, because we're trying to add up to 330. All right, well, here we're back to our schedule. So there's the 60, 100, 150, and 20. And I've just filled in the cost per units for each of these layers of inventory. I like to think of them as layers. Do the math, multiply across, add them up, and that adds up to $1,890. These two things add up to total cost of goods available for sale of $2,450, so we feel good. Notice that all 410 umbrellas are in one schedule or the other, so every dollar, every one of these $2,450 has to be in one schedule or the other. The key here is not to mix up the terms. Realize that under FIFO, ending inventory is assumed to be the newest items, and cost of goods sold is assumed to be the oldest items. The most common mistake I see in this area is students just reverse those. Well, now let's move on to LIFO, and again, that stands for last in, first out. LIFO is actually the second most common method of accounting for inventories in the United States. It's not even an allowed method if you're following international accounting standards. So as you recall, LIFO is sort of the opposite of FIFO. What we assume with LIFO is that a company is selling, we're costing inventory as if the company sold its most recent purchases first, so that cost of goods sold will always consist of the newest possible items, and ending inventory will always consist of the oldest possible items. And so you can picture that pile of gravel when you're thinking of a LIFO example. Here's our schedules, and you might want to try this one, pause and try this one completely on your own without me. But before you start, let's label these things. Under LIFO, the last stuff in, the most recent purchases were the first stuff out. So cost of goods sold are the newest 330 umbrellas, and ending inventory is the oldest 80 umbrellas. So you might want to label your schedules. Then go back to that physical reconciliation schedule and put in the cost of the 80 oldest umbrellas over here, starting from the top of the schedule, and over here look for the 330 newest umbrellas starting from the bottom of the schedule, and keep going till you get 330 over here. For ending inventory, when you go back to that schedule, the first thing that you'll notice is that the first layer of inventory is the 60 black umbrellas that were there from beginning inventory. 60 isn't enough, 60 isn't enough, we need 80. So after you take the 60 black umbrellas, go to the next oldest layer of inventory. I believe those were the blue ones. Try to complete these two schedules on your own and check your work, then come back and compare to my answers. For ending inventory, we take the 60 black ones plus the 20 blue ones. These are the costs associated with those layers, added up to $410. For cost of goods sold, there were 100 of the newest possible umbrellas, 150 of the next newest layer, and then the other 80 blue umbrellas. 20 of the blue umbrellas went here, the other 80 blue umbrellas go over here. When you do the math and add it up, you come up with cost of goods sold under LIFO as $2,040. And once again, they add up to the $2,450. And before I close this video out, I just want to show you a little summary of the 4 different methods. And the next video, I'll talk about this in more detail, and we'll talk about some of the theory and why companies make the choices they do. But let's assume now, what we're assuming is that, remember I said that Noah was going to hire some friends, and they were also going to sell umbrellas. So we're going to assume that Noah hired these 3 friends, Mo, Larry, and Curly. And the four of them had absolutely identical economic transactions. So they all started out with 60 black umbrellas, they all purchased the same umbrellas at the same cost, and they all sold, miraculously, 330 umbrellas for $10 each. So I've built income statements for each of these four umbrella vendors, and we're going to assume that Noah chose to use the specific identification method, Mo used weighted average, Larry used FIFO, and Curly used LIFO. And what I want you to recognize, first of all, is that even though they had the exact same economic transactions, they paid the same for their umbrellas, and they sold their umbrellas for the same thing, at the end of the day, they're going to have different financial statements. We can look here. Here's their cost of ending inventory on the balance sheet, and these will agree to the schedules that you built a few moments ago. And here's their cost of goods sold that will show up on the income statement. So right here in the middle of this income statement, we have a little cost of goods sold statement. Because each of these individuals has a different expense amount for cost of goods sold, they end up with different net income amounts. And in the next video, we'll compare and contrast the results here.